Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today for today's podcast. Got a lot to talk about. And of course, today is going to be about the election, given that we are 11 days away from Election Day. We are quickly going through our client quarterly reviews that we are very proud to do every single quarter with our customers. We'll talk a little bit about that here in a second, why that's important. But everybody obviously has the election on top of mind. And that's what we want to spend a little bit of time today talking about. If you're new to the show, welcome. Glad you're here. Please give us a like and subscribe to the program. That way, when we drop these things every 2 weeks on YouTube, you'll be notified of that. And certainly appreciate the viewership. And the reason why we really have gotten a lot of compliments from doing the show, why we're still here, why we'll continue to do the show about every 2 weeks on YouTube, simply has to do with the fact that customers, as well as just general, human beings walk around this planet. We all have these fancy smartphones that are great, powerful tools, great piece of technology, and not sure where we'd be without them at this point in life. But unfortunately, we get a lot of notifications sent to us, and all of that's coming from local media news, social media. And the unfortunate part about all that is human beings are hardwired with these emotions called fear and greed, going back to the beginning of mankind's inception. And what we've learned through studies like behavioral finance, which you can actually get a PhD in these days, which is, I think, very cool. What we learned from that study is that human beings feel losses twice as much as they feel good about making a gain. And the reason why that's important is the news actually understands all this, and the way that their business works is the more viewership that they have, the more ads they can sell, the more revenue that they'll have. Therefore, the profits will grow as their revenue grows, of course, like any other business. And the best way to go about getting those eyeballs on the screen is to placate to those human emotions. What we try to do here is say, yeah, this is what's going on, and yeah, this may or may not be something to be concerned about. But we would like to take a historical look at market precedents. So whatever it is that we're going through right now, there's been a precedent for it. And right now we're in election year. We'll talk about the precedents for that. We're in an interest rate cutting cycle. We'll talk about the precedents for that. And we're also right in the middle of Q3 earnings season. So what does that all have to do with all these other things that are actually going on right now? And that's what this show is all about, is providing you with the historical data, looking at the market through a historical lens. And the reason why that is important is if you understand how other human beings have behaved in the similar circumstances that we're dealing with right now, now you understand what the probabilities of success are, at least from a historical perspective. Of course, past performance is not a guarantee of future results, and investing does involve risk, including risk of loss. But when you have those probabilities in your back pocket, now you can start to make some very clear, thought through decisions. And those probabilities allow you to overweight, underweight certain sectors or stocks. And that's where you can get a little bit of an edge. And that's certainly what we've been able to provide for our customers, not only being able to keep their blood pressure down by understanding what the risk and reward really is from a historical perspective, and then going about making decisions and knowing why you're making those decisions, whether they're working for you immediately or maybe it takes some time for that to work out. But you know what you're doing, you know why you're doing it, you know what the probabilities of success are for the risk that you're willing to take, and that keeps people calm. And generally when you're calm, Buffett would say that's the number one reason that individual investors do not achieve the individual results that they should be achieving on a consistent basis is they have no control over their temperament, or in other words, their emotions. And that's what we're really trying to provide here. And today could not be more of an emotional type of conversation, really, as we are 11 days away from the presidential election. Now, before we even get into that, let's just get the easy stuff out of the way here today. And we're in the middle of earnings season, as I mentioned. We have 111 companies reporting this week alone. We have 179 companies that have reported so far in the S&P 500, so we're not quite halfway there. However, of the companies that have reported earnings thus far, 79% of those companies are beating earnings estimates, and they're beating by a median of 6%. So this is really strong stuff. As we came into this particular earnings season, the S&P 500 earnings growth expectations was about 5%, which might not sound like, a lot, or it's certainly not like a rip your face off kind of excitement, but that's really strong. That's stout. Definitely a solid earnings growth for the S&P 500, but it makes it even better as interest rates continue to come down. And the expectation right now is about 100% probability of a Fed Chair Powell cut of 25 basis points the day after the election. So November 6th in this case, it just happened to work out that way. Then, of course, they're meeting again in December before we end the year. The expectation there is about a 90% or close to a 90% probability of another 25 basis point cut. And we'll get into 2025 and we'll kind of go from there. I think that we'll continue this trend of slow, steady interest rate cuts. And we'll talk a little bit about more about that here in just a second as well, as we did get some Fed chair folks actually providing some of their perspective going into November 6th upcoming meeting here in just a few weeks, or a little less than 2 weeks. So we'll get into some of that here as it relates to the election itself. And what I wanted to share with everybody real quick, though, is when we're talking about earnings growth expectations for the S&P 500, what we have heard in the news a lot, and I've actually heard it from some clients, is that the news or certain people out there think the market, meaning the S&P 500, is quote unquote expensive. And what they're referring to is the price to earnings multiple on the S&P 500, so the PE ratio. And the PE ratio on the S&P 500 right now is about 22 times, which when you compare that to history on the S&P's PE ratio, the S&P's, about 100-year average PE ratio is about 17. And you can look at the two numbers and say, historically, the S&P is currently, expensive. However, the 7 largest companies that make up the S&P 500, I think we all know them by name now. I don't think I need to rattle them all off, but they're basically the largest tech companies on the planet. And their PE ratio is north of 30 across all of them, which I think is actually well-deserved because we're talking about the 7, best companies on the entire planet here. But the other 493 companies that make up the S&P 500, their PE ratio is 17 right now. So I would actually argue that the market is fairly valued with a really strong earnings growth. But when we compare that to something like small caps, which I've been talking about all year long, the reason for that, small caps historically outperform when we're going through an interest rate cutting cycle. We just experienced the first cut just a few weeks ago. Again, we expect more cuts to come here in the coming weeks and months. And that's one reason why we're pretty happy about small caps. But the other one is the valuation component that I want to make a quick comparison to. So the PE ratio on the small cap asset class as a whole is about 12 times. So it's certainly undervalued relative to the S&P 500 PE ratio. So you do get a little bit better value. But in addition to that, the earnings growth expectations for small caps right now is running at about the low 40% range. I think the number is actually about 43% earnings growth expectations for the small cap asset class. So when you combine the history of small cap outperformance and you look at the valuation and growth expectations with the backdrop being interest rates are going to continue to be cut and corporate profits have been nothing but fantastic, this is a pretty good cocktail, if you will, of data that gets me pretty excited about the small cap asset class, specifically comparing that to something like the S&P 500. It's not that we won't have exposure, to S&P 500 type of companies and sectors. Of course we will, but we're certainly very bullish on the small cap asset class. And I just wanted to start the show off with that as we actually transition just a little bit into actual election data. So just to make it simple to start off the top here, I decided to go and do some extra research today for today's show. And I specifically wanted to go back and see what some of the former employers of mine actually had to say about this, one of which was Fidelity. And Fidelity is a great company to work for. Had a lot of good friends there, still do. Learned certainly a whole lot about the industry as I came right out of college, right into Fidelity. So what they provided on their website for free, by the way, for those that wanted to spend some time on this, you can look at it yourself on their website. But the average annual S&P 500 performance from 1933 through 2022, and they are excluding the 2001 to 2002 period of time here in their data set. And I think the only reason for that is the basically the tech bubble burst that happened, in 2000, 2001. Which certainly was a very bad event, and I don't think we've seen anything quite like that except for the couple days post COVID. But that's the data set that they're providing us today. Now, if a Democrat president wins and the House, Senate, and House is divided, the average return on the S&P from 1933 to 2022 is 13.6%. And if a Republican president takes office and Senate and House is divided, the average return is darn near the same, 13.7. So really good stuff there if the Senate and House is divided. And right now, I'm not for sure what the probabilities are on that, but the probabilities are creeping up a little bit for Republican sweep, which I'll talk about here in just a second. I'll provide the entire data set. And this is not a pro one side or the other type of conversation here today. I'm just simply providing the data and the probabilities that we have here in front of us. And I'll talk about what that might mean for certain sectors of the market and therefore your potential returns. But getting back to some of the data set here from Fidelity, really good performance, right? Democrat, Republican president, basically the market doesn't care. If the Senate and House are split, divided, that's actually a lot of good news for the individual investors because we'll know that it'll be extremely difficult for either side to really push through an agenda. And that's good news for individual investors based on history. Really strong returns and basically the exact same return regardless of the outcome of the election itself. So that's what I wanted to kick us off with here today. If we get a Republican president and a Republican sweep, I mean, we're talking about the S&P average return from 1933 to 2022 being 12.9. On the other side of that, Democratic president takes office with a Republican Senate and House. That would be a 13% average return. So basically the exact same return. If we get a Republican president, Democrats win the Senate and House, we're talking about an average return on the S&P from 1933 to 2022 being 4.9. And if a Democratic president wins with a Democratic Senate and House, average return from 1933 to 2022 is 9%. So that's the historical data points there. Otherwise, this is actually pretty good data, pretty good return expectations, and those are the numbers that are in front of us here, which I don't think most viewers would have come up with anything close to that if they were to try to guess what the historical performance of the S&P 500 would be given these different potential outcomes with the upcoming election. And I thought that was a very nice, simple way to go ahead and kick off the conversation, just laying that data out there for everybody. So really the market, is going to be just fine. In other words, regardless of the outcome, just relax. If your favorite person does not win the presidency, just come right back to the information that we just talked about here today and chill. Everything's going to be just fine. Now, there certainly will be certain sectors that will do better than others depending on the outcome of the election and certainly the outcome of the Senate and the House, which I'll talk a little bit more about here in just a second. But I wanted to just come back and remind everybody real quick that the Fed is the key here. It's, I think, way more important than anything that'll happen with this upcoming election as far as the performance of your individual portfolio is concerned. And the Fed is still very dovish. So San Francisco Fed President Mary Daly actually reminded us this week of the dovish stance that the Federal Reserve actually has right now. So in a Wall Street Journal forum, she was quoted as saying, quote, "Is policy still tight? In my mind, it absolutely is." I would completely agree with that. I think the Fed is going to try to bring down interest rates, specifically the 10-year, somewhere right around that 3.5% to 4% range. And we're not too terribly far off from that right now. Therefore, I believe that you're going to continue to see interest rates being cut. The only reason why that would not continue, regardless of the outcome of this particular election, is if all of a sudden inflation data started to spike to the upside, and we're just not seeing that anywhere, shape, or form across any of the metrics that are being used to calculate things like CPI, core inflation, et cetera. I mean, certainly shelter and housing is the biggest component of that. We talked about that endlessly last year for nearly a year and a half, and that data is now starting to show up in a positive light, along with everything else that makes up those calculations. So I just don't see where we're going to get an inflation spike, regardless of the outcome of the election. Therefore, interest rates being cut, Fed being dovish, understanding that their policy stance is tight, specifically relative to history, and as inflation falls, if they don't change the policy at all, it just makes it even more tight naturally. And they're coming out and reminding us that this is their dovish stance, and I completely agree with that. It is the right thing to do in a healthy economy, very low unemployment, very strong corporate earnings. There's no need to be this tight. And that is a great thing, great backdrop for individual investors and definitely some sectors that we'll talk about here in just a little bit. But I also want to tie all this historical data presidential election years and what we're going through right now and kind of combine it all together, give you guys our thoughts and return expectations here in just a little bit. But back to some of the historical data that betting markets are literally betting on right now. This is real money. So you can do this yourself if you want to. Definitely not our recommendation. We are not doing that or recommending that for any customer at all. But if your um, risk your risk appetite is high, you can literally use the presidential election just like you're using any sports book that you might be using on a Saturday or Sunday for college and professional football. But betting market probabilities of a Republican sweep, and this is the data as of yesterday. Republican sweep has actually increased to 49%. That was 28% just 2 days ago. So that kind of stood out to me. I'm not sure. Obviously this is a betting market, so certainly some people are going to be wrong, and I bet a lot of people don't actually have all the data behind the scenes to really understand what the true outcome might be. But that's the data that we have right now. And that 2 day spike really kind of caught my attention. But if we get a Democratic president, a Republican Senate, and a House that's majority Democrat, that's about 23% probability right now. A Republican president, Republican Senate, Democratic House, probabilities are 14%. And a Democratic sweep is 12% for President, Senate, and House. So those are the probabilities right now. Now, I also wanted to take a look at what's the correlation. Since the odds of that Republican sweep increase in just 2 days from 28% to 49% in the betting markets, ran a little bit of a data set here showing the correlation of certain sectors within the S&P 500. And if you do happen to get a Republican sweep, the things that are most correlated with that would be regional banks, real estate, Bitcoin, financials, small caps, and staples. And all of that makes a ton of sense to me. So everything else is negatively correlated, meaning it would move in the opposite direction, of course. And that would be materials, healthcare, utilities, industrials, discretionary energy, and communication services. So that doesn't mean that those other sectors would perform poorly. They just may not be the outperformer that some of these others might be under those assumptions and correlations. Interest rates coming down, regardless of who wins the election, again, is the main point here. We just talked about the historical performance of the S&P going back nearly 100 years, regardless of the outcome of any of this. Markets do just fine. Sometimes they just do a little bit better than others. And if we do happen to get any of this to happen here, let's start with a Republican taking the White House, regardless of what happens in the Senate or the House, if interest rates are being cut and corporate profits are resilient and everybody in this country that's looking for a job has a job, that's a great cocktail recipe for strong performance. And history would say the first year of a presidential cycle is very good. We'll talk all about that in January, because regardless of the outcome of this election, there will be a new presidential cycle. So you have a lot of really good historical backdrops, tailwinds going into next year. But if you do get a Republican president, that would imply that interest rates are going to come down, of course, regardless. That would also imply, in general, potentially less regulation, less taxes. All of those things are very, very good drivers for things like real estate, Bitcoin, financials, small caps, regional banks. All of that should do very, very well. And the probabilities in history would definitely be in your favor in those asset classes. I think that those certainly would be, the outperforming sectors, if you will. And of course, if a Democratic president takes the White House, then you're likely going to still have interest rates being cut, which is, again, the most important thing. You may have potentially higher taxes, which could be not so great for certain industries like technology, as an example. And you might actually have less mergers and acquisitions from a regulatory restriction standpoint, which just simply means that you're going to have fewer mergers from large institutions because they'll likely get challenged in the court system. Therefore, financials will probably not do as well as they might otherwise be doing, because they'll certainly miss out on the consulting revenue from doing something like helping large institutions acquire another one. So those are just some very general historical types of data sets, some general theories about the outcome of this election. But the short and sweet of it is, again, history is definitely on your side in a presidential election year. The performance on the S&P is darn near exactly the same. And the most important takeaway that everybody should have here is that regardless if who wins this election, interest rates are coming down. Jobs remain extremely robust, and corporate profits have been nothing but stellar. Therefore, you should just relax a little bit if your favorite candidate does not actually win. But those are some of the probabilities that we wanted to make sure that everybody was at least aware of before this election is actually complete. And what we're doing for customers here is we're taking these probabilities and putting it to work. So certainly, home builders is a place where we feel like, regardless of the outcome of the election, should be a really strong performer. There's demand for houses to be built in this country. That demand's not going anywhere. And there's so much demand for new houses that it's going to take multiple years for home builders to meet that demand. But it becomes more economically profitable for a home builder to meet that demand as interest rates are coming down. Again, don't really care who wins the outcome of this election. That should be a place where we can, rest easily at night and knowing that demand isn't going anywhere and it just is going to get met more easily as interest rates come down. Same thing on small caps because of the interest rate stuff and all the history and earnings expectations that we just talked about. I feel good about that regardless of the outcome of the election. Really, the only thing that would change in my mind is depending on the outcome of the election, we may decide to, instead of using broad-based ETFs for this exposure, we may actually own less ETF broad-based exposure, more individual stocks. But I want to wait and see what actually happens, not just with the election, but more importantly, what happens with the Senate and the House. We just talked about the historical data set there, depending on what actually happens there, in addition to who actually takes the White House. So we feel very good about our positioning for customers right now. And certainly very, very bullish to wrap up the year here, because as soon as this unknown factor is removed from the equation, well, what would we know? We'll be really close to earnings being done for Q3. So we'll know for sure if the S&P 500 met their earnings growth expectations or beat them. I actually think they'll meet them, maybe even beat them. We'll know a heck of a lot about the decisions of the Fed, because that news is going to come the day after the election itself, which not for sure if we'll actually know the exact outcome of the election the day the election actually takes place on November 5th. Might be a few days after that. So there could be a little bit of uncertainty there in that first week of November. But we do know the Fed's going to do their job with interest rate cuts. We'll be pretty much done with the S&P's earnings, so that'll all be known. And we'll be basically right behind a election result. So that information will be known. So when we remove all these unknown factors and you actually start to look at things from a lens of clarity, it looks pretty good. Certainly there are some geopolitical risks that are out there. That'll always be the case in general for individual investors. It's not a great feeling to be an investor during an election year. We got two different wars going on overseas, and not really sure how the United States is going to, fully resolve or help resolve some of these things. So I get all that. That's a very nervous situation to be in on top of an election. And everything else that's going on around the world right now with natural disasters, et cetera. There's a lot to kind of keep your cool for. And that's exactly why we're here. That's exactly why we're doing this show. That's why I love doing what I do every day for our customers and serving them through and getting them through all of these different, variables and, potentially problems that could arise and definitely would have an impact on their individual portfolios and retirement savings. And that's something that we take very, very seriously here for our customers. So all that to say, you're hearing a lot of news. You're seeing all the television ads for all of these candidates. You're getting the memes that are out there in every way, shape, or form. And that'll just continue to get more in your face as we get closer and closer to election night. And that's really why I wanted to start the program with just saying, hey, no matter what happens here, everything's going to be fine. We've got to chill out a little bit and, address things professionally. And that's kind of where I wanted to wrap up the show here today, since we've gotten obviously clients on every side of the aisle here. And one of the things that a friend of mine brought to my attention is that this is not partisan analysis. But if you do feel this way, remember this old adage: amateurs want to be right, professionals want to make money. And that's exactly what this is all about here today. I'm here to look at our client's portfolio, and for everybody watching and listening to this program, everything that we're talking about, how we make decisions, has nothing to do with the candidate that we want to win. It has everything to do with making decisions on how will this election impact your money, right? That's what we're focused on right now. And we'll pivot if needed, depending on the outcome of this election. But the backdrop looks awesome. So we're very, very excited about that. And even if our favorite candidate, your favorite candidate, whoever that may be, does not get in the White House, everything's going to be fine. And you should have some comfort knowing this historical data. And if you actually apply this, I think that you'll be completely comfortable regardless of the outcome. And the bottom line is you're investing to make money. You don't need to be right all the time about every little thing that's going on around the world. And you certainly do not want to be one of those individuals that simply just gives up because your favorite candidate did not get in office and you just feel that the whole world is going to crumble. If that does not happen, well, that would be a very expensive lesson that you would actually have to learn for yourself. And I certainly hope that that does not happen, doesn't need to happen. And hopefully the information that you've just heard here today will put you in a position to take these probabilities and put them in your favor and put them to work in your best interest. And lastly, this is the reason why we do these quarterly reviews with customers. Every single quarter, at the end of every quarter, we sit down with them in person if at all possible. Certainly, we have to do phone calls, Zoom meetings at times. But we want to not only cover the performance, what happened and why, it also gives us a chance to be held accountable for all the decisions that we've made for them, all the newsletters, all the podcasts, all the weekly blogs that we try to send out to customers, just communicating with them what we're doing and why, what does history have to say about the situation that we're dealing with right now. And we talk about it every single quarter just to help them understand exactly where they are and why, what we anticipate to happen here over the next 3 months, and the return expectations associated with that. And all that is something that we can provide them because we are looking at the market through a historical lens, and that's providing the probabilities and therefore the risk and reward expectations that we should have. So we do this every quarter. This was a tough quarter to make money in, no question about it. Specifically with the month of September, we talked about that in our prior podcast. But overall results, nothing but fantastic. A lot of happy people because we're making them, aware of all this historical data regularly, really every week, and then talking about it in person if possible once a quarter. So that's the kind of service, that's the kind of treatment, that's the kind of respect that you're looking for from an advisor, a true guidance consultant walking along with you through all of these different potential potholes you'll have to navigate. Give me a call, 513-630-2664. I'd be happy to have a conversation with you, see what we can do together. And if nothing else, please join us back again here in a couple of weeks on the Shepherd Wealth Management Podcast. We'll continue to deliver all these nuggets. And we'll actually have, at that time, hopefully the election results themselves. We'll be done with Q3 earnings, and we'll certainly have a lot to talk about. So I'm looking forward to that. But until next time, my name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management, wishing you all a very happy Friday and a great weekend. Take care.